What's up, everybody? Welcome to Heresy Financial. This is the channel where we talk about financial topics in a way that is considered heresy to the financial establishment. And quite frankly, that means a lot of times we're discussing things that are just never talked about by your typical financial advisor or the standard mainstream news outlets. And today is no exception. What we're going to be discussing today is kind of the fallout of the repo crisis that started on September 16th. As we approach the year end here, there is mounting evidence that we are about to face a significant cash crunch. So what we're going to look at is what that will mean for the markets and what that will mean for you. Let's dive in. Thank you so much for tuning in today. Before we begin, if you are more of a reader and you like to read things more than watching or listening, feel free to check out the article that I wrote on this exact same topic. I'll link that in the description below. It's both on LinkedIn and on my website. Number two, if you are more of a listener than a watcher, I always put my YouTube videos in audio format on my podcast. You can find that podcast on my website, on iTunes, and on Spotify. Finally, if you do like watching YouTube videos and I just talk at a little bit too slow of a pace for you, if you're not aware, you can click the settings button. You can watch this on 1.5 or 2 times speed, get the same information in a much shorter time frame. And at the end, if you do enjoy the content, it would mean the world to me if you liked and subscribed to the channel. That'll help me continue to make videos like this. All right, on September 16th, we saw the repo market kind of implode. The repo rates, the overnight rate for cash lending between banks, spiked. If you're not aware of that September 16th repo crisis, what happened and how the repo market works, at the end of this video, I'll put a link to that video that I did explaining that you can watch, or it's in the description below if you want to go ahead and watch that now before watching this. Essentially though, nothing that the Federal Reserve has done since then has done anything to solve the problem. There has been a persistent need for cash and liquidity injections by the Fed because for some reason, banks are not lending in the overnight markets. Well, just a few days ago, Zoltan Pozsar, sorry, I don't know if that's really how you say his name, he basically helped design the entire repo system. He recently published his most recent article called Global Money Notes number 26, and in it, in a very technical explanation and thorough and detailed analysis, he shows some problems that I'm going to outline here for you today. I'm going to break this down for you in a way that is easy to digest and easy for most people to understand. So keep in mind, there might be details that I'm either glossing over or small details that I'm slightly misrepresenting just so that it's easier to get the entire picture. In this article, he shows how number one, the cash crunch has not been solved, but the Fed has basically only been able to put a band-aid on it. Number two, coming up on the year end, cash needs are going to increase drastically. Number three, there's a bottleneck on banks right now that is preventing them from operating freely in the repo market. Number four, because there's going to be this cash crunch and the repo market's not going to work, you could see this result in a sell-off both in treasuries and in equities. And finally, the only available fix once this starts to unfold is for the Fed to resume full purchasing of treasuries once again. All right, let's break it down. Since September 16th, the Federal Reserve has been pumping billions of dollars into the repo market overnight continuously. Now, if they were to stop doing this at any point, the repo market rates would spike yet again, which means that the fundamental problems have not been solved, which is why they are continuing to inject the money overnight, and they are now the lender instead of the big banks that are supposed to be the lenders in this market. And so if they were to stop doing that, you'd see the repo market rates spike yet again. There's been some speculation because this market has so much opacity that it's difficult to interpret the data and figure out what's going on here, but there has been some speculation as to what's been causing the liquidity crunch. One of the things is hedge funds are needing cash just like they normally do. We have a lot of hedge funds right now that are called relative value hedge funds, and they are basically, these hedge funds do a very similar thing that long-term capital management used to do. They do an arbitrage between pricing on treasuries, and because they have illiquid assets that make up a massive amount of their book value compared to their actual net value, they have daily liquidity needs, and so they use the repo market to get this cash. Well, right now banks have had their cash reserves basically drained. Most of the big banks that usually lend the cash are not lending the cash right now, and by their balance sheets, it just looks like they don't have the cash that they normally do. Instead of having cash, most of the big banks have balance sheets that are full of treasuries right now. Banks started loading up on treasuries because they assumed that the Federal Reserve was going to start buying treasuries and they'd be able to give those treasuries to the Fed in exchange for cash reserves. But instead, when the Fed restarted QE, which they're not calling QE, they started buying T-bills instead of treasuries, which meant that banks couldn't offload the treasuries that they had been purchasing. And a lot of these banks are required to purchase treasuries at auction, so they don't have the ability to just not take on any more. So instead of them being able to offload these treasuries to the Fed in exchange for cash, they've been stuck with these treasuries, and so now they don't have the cash reserves they need to lend out overnight. And the Federal Reserve has been very adamant about this fact because they don't want people to call this QE. And so the only distinction that they have is that they're buying bills instead of treasuries, which is short-term paper versus long-term bonds. Now, if you remember, last December, there was also a repo spike. Coming into year end, there's always greater cash needs, but we didn't see a massive crisis or a massive crunch because number one, banks had a big ability to lend because their cash reserves were much higher than they are right now. But number two, they did not have the Gsib bottleneck, the Gsib score bottleneck that they have right now. So let's get into that. What is that? Gsib stands for Globally Systemically Important Bank, which basically just means too big to fail. So there are these large banks that have this designation placed on them. And along with this designation comes certain liquidity and reserve requirements. So basically, based on what happens in the market, there are certain reserve requirements that banks are required to hold. Now, most people would think this is good, that there's regulation on what banks can and can't do with their money during certain times of the year, depending on what's happening with the market and what they have on their balance sheet. But there's problems that are popping up right now from these regulations because of the environment that we're in. When their Gsib scores are high, it makes these banks first have to lend in the repo market, and then from there they can buy treasuries with their cash, and then from there they can lend in the FX swap market, which is foreign currencies. And right now, banks' Gsib scores are all very high. Part of the reason for that is because of the flat yield curve, and the other reason for that is because of the equity markets, the stock market being so high. Because the books of their equities are so high, and because the stock market is so high right now, that's pushing their Gsib scores even higher. So it's restricting banks from being able to do anything in the FX market, and they're basically forced to operate only in the repo market. But the problem is even though they're required to operate only in the repo market and they can't get to that FX market, they don't actually have the cash to do that. This leaves the FX swap market wide open to a massive panic because there's really no money that's available to go through the FX market. Now, these hedge funds that have to borrow money are not really worried about this because they say that they've established forward settlement contracts already to lock up the funds overnight that they'll need through the year end. But the problem is these contracts don't specify what rates they're going to get this cash at. So there's a very good chance that the dealers who have an incentive to want to make money for their banks are not going to be offering the cash at a very reasonable rate, especially due to the fact that they want these rates to spike because that will make them money. What that means is that when there's this big liquidity crunch that's going to start happening over the next couple of weeks, you could start to see both treasuries and equities be sold off in order to generate the cash. Over the last year, we've seen something that's usually not the case historically, where both treasuries, bonds, and equities have been rising together. Usually one offers a safe haven from the other. But in this case, they have been going up together, and due to the year-end liquidity crunch, we could see that trend reverse very rapidly as there might be a quick sell-off in both treasuries and equities in order to generate the cash needs year-end. And especially since this cash crunch looks like it's being generated from the hedge fund side and they deal with these massive books of treasuries in arbitrage trades, there's a massive amount of treasuries that could start to be sold off. And once this starts to happen, it could trigger a snowball effect where it makes the problem worse and worse and worse, and the treasuries need to be sold at faster and faster paces. This leads to the only available fix that the Fed has in order to stop this problem once it starts unfolding, is to start buying treasuries and put a floor underneath the selling at full force. And this is something they've been very adamant that they don't want to do and that they're not doing because they don't want people to call what they're doing QE. They're buying bills only, not treasuries. And so it doesn't look like this is something that they're going to try and front run and get ahead of because they don't want to buy treasuries until it looks like it's absolutely necessary. And so we could see this trigger a snowball effect where treasuries start to get sold off and equities start to get sold off before the Fed comes in to put a floor underneath that selling and buy up all the treasuries. And you know they will have to if this happens because they can't let yields spike from a sell-off because the debt service load would be much too expensive for the economy and the country to handle. And so they are going to come in and provide a floor underneath the selling if this starts to happen. Now, just about an hour ago, I saw that the Fed came out with a plan for the end of the year cash needs, and they're expanding the amount of repo operations that they're going to be doing through the year end. And it looks like they're committing about $500 billion to the repo market through the end of the year, which, just as a side note, that's insane. There is so much money that the Fed is already pumping into the markets that they know is not enough, and so now it's up to $500 billion through the end of the year. But the even crazier part is that it doesn't even look like that will be enough, because you still have the problem showing up in the FX swap market. Basically, it looks like they're trying to hold a lid down on the rates in the repo market, and all that pressure is building up and it's going to explode out in the FX market. So the bottom line is we have a recipe coming into the year end where we could see a big sell-off, a big correction, or maybe even what could be called a crash in both treasuries and in the US stock market. But even if that doesn't happen, even if the Fed steps in and starts this rescue operation with full force before it looks really ugly, the bigger issue is the systemic rot and fragility that we see right now. The entire system is 100% reliant on a continuous, persistent, and growing intervention from our central bank. That is not a healthy system. Further, the only tool that the Fed has in order to rescue in this operation is printing money. That shows up in a multitude of ways, but the bottom line is everything that they do is just printing money. And if you've been around this channel at all, you know that printing money eventually leads to price inflation. And at the rate they've been printing money, the price inflation that we are about to see is potentially unprecedented in United States history. This can't go on forever. We have a cracking foundation that's being held together by chewing gum. At some point, the system is going to break. And if you're watching this video before this starts to unfold over the next couple of weeks leading up to the end of the year of 2019, you do have a chance to try and prepare. Now, I'm not guaranteeing that there's going to be a stock market sell-off or even a treasury sell-off, but it looks like that's what's going to happen. So full disclosure, I am currently short the S&P 500 through the use of put options. And this is not investment advice or individual financial advice. This is meant to be purely educational. So if you want to prepare, what can you actually do? Because the stock market's not safe, bonds aren't safe, cash isn't safe. What can you do? Well, the ultra wealthy are currently stockpiling gold. Central banks and ultra high net worth individuals are stockpiling gold like almost never before. Gold is the only asset class that is not at the same time somebody else's liability. It doesn't depend on what somebody else does for that asset to maintain its value. But the reality is most people do not have the ability to put the majority of their wealth into physical gold. Most people have the majority of their wealth tied up in their home or in their retirement accounts. Now, we've seen the VIX spike a little bit over the past couple of days, and that has been at the same time that the S&P 500 has not been dropping and has maintained a relatively flat level. Other than today, it has spiked a little bit from trade optimism. What that indicates is that there's a large amount of money that is currently buying options on the market because of the way that the VIX is priced. And so investors in retirement accounts, especially self-directed retirement accounts, do have the ability to purchase options to hedge their portfolios. If you're interested in learning how to do this, I have a link below to my personal course that will teach you how to use options effectively. Now, whether this turns out to be a blip on the radar or whether this turns out to be the virtual match that lights the fuse for the system ultimately collapsing, nobody can know. What we do know is that there is a ton of rot in the system, and it is built on a foundation of unsustainable debt and stimulus, and at some point, something has to give. So whether you want to try and ride out the storm, or whether you want to try and start to time the market a little bit and potentially prepare yourself for the coming collapse, that is 100% up to you. But we could see the next few weeks unfold in at least a very exciting manner, as history may look back at these next couple of weeks and show that this was the beginning of the end. I really appreciate you hanging in there and watching. If that was confusing, feel free to go read the article that I wrote on it. It breaks it down a little bit better, and I also have Zoltan Pozsar's original article linked in my article as well if you want to take a look at the source. If you like the content, it would mean the world to me if you would like the channel, subscribe, support me on Patreon in order to help me continue to make videos like this. Thank you for watching. You guys have a great day.